everyone, CryptoCam here with Valuing a Cryptocurrency, Mastering Cryptocurrency Investing. So, the simple question, how can you value a cryptocurrency? The simple answer is that the value of something is only what someone else is willing to pay for it. In order to know what something is truly worth, you need a busy market. Lots of people wanting to buy and lots of people wanting to sell will always yield an accurate price. This is called a liquid market. When there are many buyers and few sellers, price goes up. The opposite, and price goes down. When there are few buyers and few sellers, that is when we have an illiquid market and price cannot be reliably predicted. Luckily, most of the top 100 cryptocurrencies and many below that ranking are very liquid markets. So you're not satisfied that something is valued based only on what someone else is willing to pay for it in a liquid market? You need more evidence? Well, what does a bar of gold do for you right now? Can you make your own jewelry from it? Probably not. It's shiny and might make for a nice paperweight, but what value does it really have? Would you just stick it on your shelf? Probably not, because there are people willing to give you a lot of cash for it, and there is more you can do with the cash. Unless, of course, you think that bar of gold is worth more next year than it is now. Then there is value to hold it. You value it based on its potential for gains, not its current utility. You choose not to sell, so you take liquidity out of the market in hopes that a greater demand will drive up price later on. But gold deposits are still being discovered and it is still being mined. Aren't gold holders worried that we might just find the world's largest deposit of gold in the Arctic and that could drive down the price? Gold miners are working around the clock to do that. We value government-issued currencies in the same way. We know what we can buy for it, but otherwise it is backed only by a promise and not even a supply of gold in a vault anymore. They can print more money whenever they wish and choose what it costs to borrow at any time. Plus, when you hold a government currency, you hold a little bit of the debt of that government in addition to its promises. But gold and government currencies have histories. We know how stable they are even if the past may not safely predict the future. How can we value a cryptocurrency that has only been around for a few years? Let's take the example of Facebook and Google. Both are networks that serve a unique purpose. Both started out as public companies that did not make a lot of money but grew a base of loyal users. Their stock was valued primarily based on active users' growth more than the amount of actual money they were able to earn selling ads. The stock price rose exponentially at times while the naysayers continued to question the value of these companies. Yet the investors who stayed were richly rewarded. These investors clearly understood a concept known as Metcalfe's law. Metcalfe's law states that the value of a network increases based on its square of its number of active users. We all know that Facebook with 2 users, Google indexing only 10 websites, or a cellular network with 1 tower has virtually no value. The concept might be valuable, but the network does not prove that value. As these businesses grew, their active users, their valuations skyrocketed to the point that Google and Facebook are 2 of the most valuable networks in the world today. Today, nobody questions the value of Google or Facebook, and their stock price reflects it. Think of a cryptocurrency as a network of loyal users and supporters. Their developers, the miners, and the investors all working together to grow their network to serve a purpose. So can we use Metcalfe's law to help us value a cryptocurrency? If you dig deep enough, you can find how much use a network is getting. Let's take Ethereum for example. I'm going to show you two Ethereum charts. Both are standard scale and both vertical axes start at 0. One is price versus time. The other is network transactions versus time. Here is the first one. Here is the second one. Here they are together. Pretty similar overall, right? Because these charts are connected by Metcalfe's law. The chart on the left is network transactions and the right chart represents price. And you can see where price got ahead of itself in June, the red arrow, and what was undervalued in October, the green arrow, and price reverted back to following the same network use curve. When one chart gets ahead of the other, they seem to connect and get back in line again. Again, there is no charting trickery here. Both vertical axes start at 0 and both are linear, not log scale. So when you see the price of a cryptocurrency go up for seemingly no reason, look at this relationship as confirmation of the value of a network that is receiving rapid adoption of interest. For mineable currencies, you can also use the cost and difficulty curve to mine a coin as an indicator. For the 2 largest cryptocurrencies, Bitcoin and Ethereum, the difficulty to mine a coin is set to increase exponentially. So the cost to mine also increases exponentially. and therefore price has to follow to keep the network fully supported. These networks are not maintained for free, and the cost to maintain them reflects on the value of its cryptocurrency. So, in summary, cryptocurrencies have value for these reasons. There is a liquid market that determines price. The size of the network's active users, also in cryptocurrency. When users overcome their barrier to entry and join one network, they are more likely to join multiple networks. So the users on one network, say Bitcoin, carry a small amount of collateral value to other similar blockchain projects like Dash or Litecoin. The relative cost trends for supporting the network can create an intrinsic value of wholesale price to mine a coin. The number of coins in many cases are finite, so supply has a hard limit while demand might increase. The next time somebody tells you that Bitcoin is worthless because they cannot hold it to pay for their electric bill, just think of Google, Facebook, and how we have valued networks throughout history. Then do your own research and decide for yourself. But for those who say it's worthless, now you can answer them back, drop the mic, and walk away. Of course, cryptocurrency investing and trading carries a significant amount of risk. You could lose your entire investment. Fast Crypto Coins is not a registered investment advisor. This content is for educational purposes only and does not constitute investment advice, nor should the discussion of any coin be considered a trade recommendation. You must do your own homework from multiple sources regarding any cryptocurrency investment. Please note the date of this video since the cryptocurrency environment can change rapidly without notice and elements of this video may be extremely time sensitive. This video is considered current only for the date it was posted. Thank you for watching, everyone. Make sure to subscribe to get notifications when a new video is posted. Follow our Twitter and stay up to date on our blog. Take care, everyone. Thanks for watching.